What you're seeing on the screen right now is a combination of my $32,000 investing portfolio. Now, within these investments, I do hold a decent amount of dividend-paying stocks. And so I want you to hone in on this annual income of $957. What this is saying is that for doing absolutely nothing, aside from putting my money into the stock market, I'm going to be paid annually $957. And this is the very concept that got me into investing, because there's nothing cooler than being able to sit back on the beach doing absolutely nothing, your feet kicked up, a drink in your hand, and you're just relaxing while you know you're getting paid to do so. It is something that has always blown my mind that it's a possibility. And though it does take a long time to establish your accounts to get it to the point where you can retire off of them, I think it's something that is definitely worth working towards, and that's exactly what I've been documenting here on this channel. Now, in this video today, what I want to talk about is the best ways that you can start that dividend investing portfolio, what's going to be most beneficial for you, and how you can maximize your earning potential. So let's just jump right in. All right, listen, if you guys are brand new to this channel, hey, I want to say welcome. My name is Dalton. This is D-Lits TV, and on this channel, we talk about all things personal finance and investing related. Now, yes, I'm deep into that dividend investing journey, and it's only up from here. I'm really excited to get that dividend snowball rolling, but I think it's important to break down the basics so that way the newer investors, people who are just coming to the market and want to get started with dividend investing, they're doing it in the most advantageous way that they possibly can. And the very first thing to note is how you're going to be investing your money, meaning what account is the most beneficial for you. And so if you haven't heard the term Roth IRA before, I would highly suggest looking it up, because that is it is the best way that you can possibly go after dividend investing. And I want to just say, lead off, guys, I'm not a financial advisor, so don't just copy randomly some guy on the internet with investment advice. I would definitely recommend going out there, learning these terms, and understanding if it is the right decision for you to make the investments that we're going to be talking about. But anyways, on that note, understanding the account that you're going to be investing in is highly, highly important. Now, I recently released a video. I actually walked through my girlfriend the very first time she ever set up her Roth IRA. And so I'm going to link that right here so you can be taken to that video. That account is the first thing that you want to look into if you're going to be doing a dividend investing journey, because you're not going to really have to pay taxes on the investments that you're making. Now, with that account, you can invest up to $6,500 per year into it, and it's going to grow completely tax-free until you reach the retirement age. If you do take out any gains that you've made beforehand, you will be paying a penalty tax on that. However, what's really cool, and something that I didn't really understand fully when I learned about Roth IRAs, is that the money that you are investing, as long as you're not taking out the appreciation value. So for example, let's say you invested $500, you end up looking back at your account, it's worth $512. You could take out $500 without that penalty. However, these accounts are definitely recommended to leave them in and let them grow for the long haul. Okay, now when it comes to dividend investing, there's some terms that you should be familiar with in order to see some success here. So first is actually understanding what that dividend is, which is a payment that's made by a company to its shareholders, usually in the form of cash or additional stock. Now, the dividend yield is the annual dividend payment expressed as a percentage on the current stock price. So basically what happens is the company will say we're paying X amount, a dollar value in dividends, and then the dividend yield looks at the price of the stock and it expresses it in a percentage. So the percentage might change as the stock price goes up and down, but that payment that has been determined will stay the same. Now, you also got things like a dividend reinvestment plan or a DRIP program, which is offered by some companies that allows shareholders to automatically reinvest their dividends into additional shares of the company's stocks rather than receiving cash payouts. And then you've also got something known as the payout ratio, which is the percentage of a company's earnings that are paid in dividends. So a high payout ratio, it really indicates that a company is paying out a significant portion of its earnings to the shareholders, while a low payout ratio suggests that the company is actually retaining a large portion of its earnings for reinvestment within the company. You also got something known as the Ex-Dividend Date, which is the date on which a stock's price is adjusted downward to reflect the payment of an upcoming dividend. And as an investor, you must own the stock before the date in order to actually receive the dividend payment. You also got dividend growth rate, which is the rate at which the company's dividends have increased over time. A company with a consistently high dividend growth rate is often seen as more attractive, as it indicates a strong financial performance and commitment to rewarding its shareholders. Now, we're going to talk about things like Dividend Kings and Dividend Aristocrats, which are also very important, so I'll leave that for a little bit later. All right, so let's say you've understood the difference between the types of accounts you can invest in. Now we're looking at what investments should you actually be making. And what I think is the best approach, just looking at facts, statistics behind investing, going after a broad ETF is really, really helpful, and understanding what types of companies are within that ETF. An ETF is a basket of stocks that you can invest in, so you get a lot of great diversification right off the bat without having to actively manage your own portfolio. So if you like to be just a completely hands-off person, maybe you're a little bit lazy in the way that you like to handle your money and you want to not really have to worry about it or lose sleep over it and check in on it every single day, ETFs are a great option if you are following that style. Now, another route you can take is selecting individual stocks, which we're also going to take a look at. But just jumping back into my portfolio, because I like to showcase what I'm actually doing. One of my bigger holdings for an ETF is in something like SPHD. Now, this isn't going to have the craziest returns in terms of market appreciation, meaning if the stock market goes up a bunch, this is a little bit less volatile. However, the stock market's been down a ton recently, and what we're seeing is this has been relatively stagnant, right? Over the past year, it's actually up 0.42%. The S&P 500 as a whole is down. So if you look into this, you can see my return on this right now is $571 or 25%. And what's cool is that on top of that return that I have, I'm actually being paid dividends from this. So if I continue scrolling down, I think you can see the history of the dividends that are being paid. And it looks like, yeah, so every single month I'm getting around $9 from this individual investment. Now, what's cool about SPHD is it targets, like I said, those high dividend but low volatility stocks. So for me, it fits my investor profile extremely well. Now, I see a lot of other investors, and myself included in different portfolios too, target Schwab's dividend ETF, which is SCHD. And if you go into this, you can look at a little bit of the stats and statistics here, but scrolling down, you can see in this portfolio, I have 15 shares at $1,161, an average cost of $66.30, and a total return of $166. Again, dividends are not being factored into that. And what I do is every single time that I'm paid a dividend, I actually reinvest it into more dividend paying companies. That way, as I'm getting those dividends, my next payment that I'm going to receive is going to grow if I reinvest it in that same company. And it's just this really cool snowball that gets rolling. Now, the other thing is a lot of people come into the stock market thinking that the best way to invest is going into individual stocks. And I, again, would like to stress the importance of ETFs and the ease and peace of mind that you can have through investing in ETFs. But if you're looking for specific dividend stocks to invest in, here's what I would recommend starting out your research with. It's looking at what's known as Dividend Kings and Dividend Aristocrats. So Dividend Aristocrats are companies that have been increasing their dividend payments for the past 25 plus years consecutively, so almost as old as I am. And then Dividend Kings are companies that have been increasing their dividend payments for 50 plus years consecutively. And what this means is that, one, they have established a really credible line of, payment schedules, right? Where they're actually going to be emphasizing their dividend, because once you're in these groups, once you're a Dividend Aristocrat or a Dividend King, really prestigious groups that you want to be a part of, and it's going to entice more people to invest in you. So once these companies get in, you're going to notice these are really well-known companies, very well established with high market capitalization, meaning that they deal with a lot of money on an annual basis. And anyways, let's just look at this website right here. Now, this is suredividend.com. And what I like about this is they have a list of all of the Dividend Kings, all of the Dividend Aristocrats in a really nice, digestible way. And it actually lists out their top 5 that they have as well. So you can get a ton of information from this website. And you can see, like, for example, this one is Target Corporation. Everybody knows about Target. Now, these reports do a great job of breaking down statistics that are key to making investment decisions. So you got the current price here, fair value price is what they think is the right price for the company. You got things like the market cap, the dividend dates, the dividend yield of the stock, and all very important things to consider when you're looking at dividend investing. Now, it doesn't only do this for Target. You can see here's ABM. You can scroll down. You got more opportunities, Lowe's, and so on and so forth. Now, you can get a detailed report on absolutely all of the dividend kings and all of the dividend aristocrats as well, which again, it just helps with that purchasing decision. And so a lot of people come into the market and they get swept up under the concept that the highest dividend yield is the most important thing when you're a dividend investor. However, you need to be really cautious because there are such things as dividend traps, where companies come into the stock market with an extremely high dividend yield. I'm talking like well above 10%, sometimes above 20% and beyond, where it almost seems too good to be true in terms of how much they're paying for a dividend. And a lot of times that is the case. So they entice these investors to come into the organization, start investing their money. And what happens is they end up cutting their dividend. And oftentimes these companies can go out of business altogether. So it's really important that you look at these well-established companies. And I think starting with those 2 lists is very important. So one of the most common questions that I receive here on this channel is, how do I pick my individual investments? And though I lean more towards those ETFs now, what I look at for those individual investments are things like long-term profitability. Have they been growing their revenue? Are they in the black, so to speak? Are they not in the red, right? Meaning, do they have debt? Because if there is an outstanding amount of debt, you're not really going to have dividend payments coming from that organization. So for example, Tesla, who has tons of money in debt, you're not really going to see that dividend payment for a very long time, because what they do is they reinvest that money back into the business. They pay off debt. They're looking to grow and expand in other ways, whereas dividend companies a lot of times are very well established and they don't necessarily need the money to continue growing, or they don't have that aggressive growth plan where they need to reinvest that money. So that's just one thing to consider. Now, I also look at the cash flow, right? So you're looking at revenue numbers, you're looking at how they're managing their money. I like to look at leadership and understand. A lot of times I've actually sat in on earnings call, and you can pull up so much information, even as a beginner, just hearing the terms and hearing the conversations that these people are having. It's really cool just to pick up and start, doing that extra research, doing that extra step to ensure that you feel comfortable with what you're investing in. Now, another thing that's always top of my mind when it comes to investing is understanding sector trends. So for example, when, COVID happened and a lot of things were shutting down, I made an emphasis on some of the healthcare and some sectors that I really thought were going to have a long-term benefit as a result of the tragic situation. So with some of those investments, I've seen some very solid returns. And if you think about it, everybody's sort of mindset and concept between, health and, general household products that they're purchasing and their cleanliness level, it just kind of makes sense to go in that realm. Now, a lot of people like EVs, electric vehicles, and eco-friendly, sustainable companies. That's just another route you could take when looking at investing as well. So I try not to get too tripped up when it comes to the payout. I want the ratio to be actually relatively low. Makes me feel a little bit more comfortable, because again, you won't fall into dividend traps. You won't put money into companies that aren't sustainable, that are going to end up just like going bankrupt or losing a bunch of money and your investment goes down. It's just important for me to understand, where they're at in terms of their dividend yield, how much they're paying their investors as well. And then on top of that, just general knowledge, like looking around the industry, thinking and talking with other investors, getting feedback, advice, looking into different investments. There's just a number of ways that you can take your research to the next level. Okay, so I'm a really visual learner, so I thought it would be good to go over a little bit more about my portfolio. You can see this is the projections that we're looking at for the next 5 years. If I don't invest any more money into this, I'm going to have a starting annual income of that $957. It's going to end at $1,313. I think this portfolio value was somewhere around $32,000. It's going to end around $42,619. And that's, again, not reinvesting, not doing anything. If I were to go out, 25 years from now, this portfolio value is going to be $148,767. and I'll be getting an annual income of $5,786 every year, right? And it's going to be on different payment schedules. But let's say now for this scenario, we are maxing out our Roth IRA, which is what I was talking about at the beginning of this video, which would be $6,500 annually. And honestly, like as you're making more money, as you scale up your income and, you're progressing in your career, it becomes a lot easier to invest this kind of money. So your ending value, $77,373. You're going to be getting, and this is just in 5 years from now, $2,012 in annual income. But let's say you're able to max it out for the next 25 years, which me being 26, that would put me, still before retirement age of 65. That's going to put me at 51 years old, so I'll still have a while. But that's going to make this portfolio ending value $481,000. You're getting well over $1,000 every single month additionally on top of whatever you're making in annual income from this. Just really, really cool. $15,000 there. And again, $6,500 is great to max out your Roth IRA. It's not going to be enough. You're probably going to be investing more than that. It's important to look at it, just take it one step at a time. These values seem really overwhelming, but again, when you have a lot of time like myself and like most people watching these videos, it's creating those baby steps and just staying on top of your investing, on top of your spending, and making sure that you're scaling, right? Scaling your income, scaling your career, and continuing to build out your future. So anyways, thank you so much for checking out this video, guys. If you did take anything away, make sure you smash that like button. I'd really appreciate it. Thank you and have a great day.